What's up guys, welcome back to the PA trading course. Today we're going to talk about leverage and risk management, two very important things. Many people say this is boring, and maybe this, in my opinion it isn't, but these are two very important things, which makes a difference between a trader and a profitable, long-term profitable trader. So stick with me for this video because it's going to be a very important one. If you understand these two topics, trading will become less stressful, and you will have more peace of mind, which is very important in trading because you have to be able to control your emotions. So as always, let's start. Let's start with leverage. Leverage means you control more money than you actually have. For example, if you use 10x leverage, you have a position worth 10 times more than you have. So if I have a position with $10 margin and I use 10x leverage, my position is worth $100. If I use $100 margin and I use 10x leverage, my position is worth $1,000, and so on and so on. This is very powerful because that way, with little money, with little margin, you can manage big positions. This is why people still trade on their own capital and don't always go to funded to loan tons of money. They use their own capital because with leverage they can still make nice gains with small positions. The catch is this goes both ways. So you will trade with 10 times bigger position, but if you use 10x leverage, for example, let's keep that as an example, you'll also get liquidated, as we call it, more later in the video, or stopped out, or lose all your money 10 times faster than if you don't trade with leverage. And it's the same if you use 100x leverage, your position size becomes 100 times bigger, but you'll get stopped out or liquidated, lose all your money 100 times faster. So more about this liquidation thing. So if I buy something right now and it drops 10%, my money I have in this asset drops 10%, but I still have money, it just dropped in value. When do I have $0 left? That's when that asset moves to $0. Then I have absolutely nothing anymore. Price can drop 90%, but I still have some, like 10% left in this position. But when do you have $0, exactly zero left, is when price drops 100%. But when you use leverage, as mentioned, for example, I use 10x leverage, but position becomes 10 times bigger, then that doesn't mean that I lose all my money of all my positions worth $0 when it hits minus 100%, but can do the math already, 10 times, so 100 divided by 10, it's when price drops 10%. And that's a big difference. Of course, in trading, 10x leverage isn't that much because most of the time you're not trading for a 10% loss, but yeah, that's the difference. But also, of course, works in both ways. For example, if I enter the trade with $100, my margin, no leverage, and I want to make it to $200, price has to gain 100%. Let me make this 100%. Then my initial investment of $100 becomes $200. But when I use 10x leverage, instead of it becoming $100 to $200, this will become a $1,000 margin. 100% profit of 1,000 is $2,000. So instead of making $100 profit, I make $1,000 profit. 10x, always divided by 10 or times 10 if you use 10x leverage. If you use 50x leverage, you always divide by 50 and do times 50 to calculate these things. So leverage basically allows you to trade with a bigger capital. You lend that money, is not really the way you call it, but to understand, you lend that money from the exchange, from the broker, to trade with a bigger position, which is not your money, but you can use it. And that's also why you can get stopped out or liquidated way earlier, because of course these exchanges or brokers are not going to give you money just only to make profit and not be able to lose. So again, as mentioned, if you use 10x leverage, your position becomes 10 times the worth of what you put in, but also you get stopped out or liquidated, you lose all your money instead of minus 100%. If you're down 100%, minus 10%. And as mentioned, but I'm going to repeat it because it's very important, if you use 100x leverage, for example, your position becomes 100x bigger and you lose all your money, you have $0 if price drops 1%, because 100% is normally what you lose, divided by 100 because you use 100x leverage is 1%. Now leverage is something people tend to find hard to understand at first, so if you don't understand it yet, I wouldn't panic. We'll give more examples later in the video, also connected to risk management, so it will be clear. And also, if you still don't understand it, you can read about it as always. That's what I really like. Ask ChatGPT, ask AI, they can explain it. Join the server, there's also written text about it, ask questions. And if you still don't understand it, do what I did and what many people did. You have to do it. Go to the exchange and play with the leverage. What is leverage? Where's my liquidation? It works like that. I'm here to give you tips, I'm here to help you, but I'm not the gold teacher, unfortunately. So if you still don't understand, which I doubt after watching the full video, of course, yeah, ask others and try it out yourself. Now let's talk about risk management. Risk management is one of the core principles of trading, which also makes it not gambling, because when you gamble, you most of the time don't know what you can make and what you can lose. But risk management, you literally, before you enter the trade, you know, I'm risking this amount of money to gain this amount of money if price hits my TP or my stop loss. Beginners and people who don't want to spend much time trading, they just enter a trade with an amount of margin of their gut feeling. Maybe they enter with their whole balance, whole account size, and then they're in a loss and they say, ooh, I lost 50% of my account on this trade. That was not meant to be. And that's how you blow your account, that's how you lose a lot of money, and that's very hard to make back. Now you have to decide this for yourself, but me personally, I risk 1 to 2% every trade. So when I trade with an account, what the balance is $1,000, that means every trade I'm risking 1 or 2%. Let's take 1% as example for all these examples, as that's easier to work with, to calculate with. So $1,000 balance, 1% risk, which means I can lose $10 per trade because I risk 1% per trade. This way everything is clear and you don't have to sit behind the charts during the trade. Oh, how much am I going to win, how much am I going to lose? You don't have to, because you exactly know what you can earn, what you can lose. And as mentioned, that also makes it not gambling, because you literally have your plan there. So this video is a bit more math and a bit more calculations, but it's not really not that hard. Position size. Before you enter a trade, you calculate your position size. And as mentioned in the leverage example, many people just do it their full account and will lose or will win what price does. Or they just do, let's do 30% or feel like this or feel like that. And that's how you can win a lot of money, because you're over risking, but you can also lose a lot of money, and that's the more likely outcome, trust me. That was a lot of talking, let's visualize things now to make it easier. But your position size is based on 3 things. Your account balance, how much you have to trade with, how much you want to risk, mainly 1%, 2%, maybe 5%, or many people, surely when they start or are learning strategy, there is only 0.2%. Surely if they have a big stack and not just $1,000 or $5,000, they trade with $50,000, risking 0.2%. It doesn't seem much, but it's still a lot of money. And surely when you're a beginner, yeah, you don't want to risk too much. And thirdly, your stop loss. That's the most important thing, because we calculate based on a stop loss and not based on our take profit. For example, this is a position. If you're not familiar with this sort of box with the green and the red, quickly explain, this is your entry, this is your stop loss, this is your take profit. Very, very easy. This stop loss, for example, I did this randomly, is 0.8 to 1%, as you can see below. But maybe in another trade you use 2% stop loss, in another trade you use a very tight 0.40% stop loss, but you will lose if you calculate your position and say I want to risk 1% on a $1,000 account. In every trade you're risking $10. It's not that this stop loss is very tight, that you're only risking, let's say, $3, and this stop loss is very big, that you're risking $50. No, you calculate it based off your stop loss. That's also why many people think, why do people scalp or have their stop loss or take profit at 0.4%, something very small? You can make money with that. You can, then you just have a bigger position. If I use my stop loss very wide, then of course my TP will also be bigger. Then I use a smaller position, because my stop loss is way bigger. And this may sound not familiar or may sound not logical, but you'll understand it. So once you calculate your position size, and I'll show you how to do it, it's very easy. Maybe at the start it seems like a lot of work, but surely after a couple of times it becomes very easy, very quickly. It's not that much work, and surely if you become an experienced trader, you will just learn it out of your head how to do it. It's really not that difficult. So if you have your position size, you know exactly how much you're risking, how much you can make, and it gives you peace of mind during trading. So a small part of risk management is your risk to reward ratio. I don't think I mentioned or talked about this in the previous videos. I do know I talked about it on TikTok. I upload education videos and a lot of videos on TikTok, so surely make sure to check that out. Link is in the description. But I don't think I talked about it yet in this series, but it's very, very easy. RR, or risk to reward ratio, is basically how much you're risking for your reward. So for example, in this trade, you can see risk to reward ratio is 2.99. Let's make that 3. So for example, if I risk $10 here, if my stop loss gets hit, I risk and I lose $10. That means if my TP gets hit, I'll make $31.08. So if let's make that round numbers. Let's say my risk to reward ratio is 3. Makes, if I calculate my risk and my stop loss, means I lose $10. If my TP is, that means I'm winning or I'm earning $30. So a 1 to 3 risk to reward ratio is big, you may think, but this is also part of a strategy, because a 1 to 3 risk to reward makes you able to be profitable with hit rate less than 50%. Because if your risk to reward ratio would be 1-1 and you have a 50% win rate, you hit 50% of your trades and you lose 50% of your trades, you're break even. So your hit rate is 33%, but because of your healthy and good risk to reward ratio, you're still profitable. This might not be the best explanation, but it will become clear. And I know I said it a lot, that it will become clear, but this is very easy to understand. Your risk to reward ratio is basically just how far your stop loss is, how far your TP is, and just that ratio between those. So how does that link with position size? Basically, you know, for example, if I use 3RR, that doesn't mean I sometimes don't use 4 or 2.5, it's just around that range of 3. I'm not going to use 1 or 10, around that 3 range. That means I just basically know I'm risking 1%, so I'm risking $10 to earn $30. If the RR risk to reward ratio is 3.5, I know I'm risking $10 to win $35. And that makes it very clear in my head. And as mentioned, this big RR, some might say, is so you can be profitable with a win rate below 50%. Not that of course we want to lose many trades, can still have a 70-80% hit rate with this, but that just gives less pressure on winning every trade. So I hope you kind of understand what leverage is and what risk management is and how important it is. But now I'm going to explain something that many people misunderstand. And if you understand this, you're ahead of a lot of people, because a lot of people don't know this or don't understand this. So basically, when people say you're trading with high leverage, they say, are you gambling, you're risking too much, because if you use 100x leverage or 200x leverage, price has to drop 1% or 0.5% before you lose everything. And people say, price can easily do that in a second, for example, you're just gambling, that can easily happen, but that's not true. Because your position size, your risk and reward, is not based on your leverage, it's based on your position size. So let me say, for example, my stop loss is 1%. That means I can easily use 50% leverage. You have to calculate it. So normally, without leverage, in an investment world, you lose all your money when price drops 100%. If I use 50x leverage, that's 100 divided by 50 is 2%. But my stop loss is 1%, so that means here's my liquidation somewhere at 2%. That's perfectly fine, because my stop loss is here and my liquidation is below it. Perfectly fine. But if I have a stop loss of 0.5%, I've made it 0.5 in that range, I can easily use 100x leverage, but because 100x leverage, 100 divided by 100 is 1%, means I get liquidated or lose all my money 1%. But I won't lose all my money because my stop loss is above that level, so I can use 100x leverage. And if you're scalping means you're trading very quickly, like in minutes or tens of minutes or seconds even, you're in and out. You may have a stop loss, let's zoom in, of like 0.2. And then you can easily use 200x leverage, because 100 divided by 200 is 0.5. That's somewhere here. But my stop loss is above that, so same thing, I can use that. It's perfectly safe because I know my plan. I know I get stopped out when price hits this, and my liquidation is there, so I don't risk losing everything. And that's a big misconception. People think high leverage just means you're gambling, but it's not, because risk management, and you calculate your leverage based on your position size and your stop loss, your plan, and not based off other things which people apparently think. And that's something very important to close this topic off. Leverage does not change your position size, it only changes the amount of margin you put in. If you use a high leverage, you can use less of your own margin. If you use a low amount of leverage, you can use more of your own margin, your own capital. But this does not affect your P&L, your profit and loss. This does not affect your position size. This only affects how much margin you use. So something very funny, if I see people say, are you trading 100x leverage, 200x leverage, you're gambling, why use so much leverage, you're going to get stopped out, you have no plan. You basically don't have to argue with them, and just knowing yourself, okay, they're not on this level yet, they don't have proper education, they don't understand it, and just because you don't want to argue with them, because you're not going to win, because they just don't understand. But if you understand this, you know you're ahead of them, and you know you actually know that you can safely use 100 or 200x leverage, because many people say, no, I'm staying away from that, that's way too dangerous. But if you calculate your position size and you know your plan, that's perfectly safe to use. So I'll now show you how you actually calculate your position size. This is the final part of the video, and then you can chill and relax and just understand what has been said in this video. So I made this position. Imagine if price comes here, you want too long. Okay, so I made this very round numbers. So TP is at 93k, entry is at 90k, and stop loss is at 89k. Just round numbers to have some easier calculations and make it more clear. Risk to reward ratio is 3, perfect. So this is your setup. Now let's also, for this example, take I have an account size of $1,000 and I want to risk 1%. Now this is a site you can use. Calculators is called. There are many sites that can do this, just some math calculations. So you see it here, don't have to look at this chart, it's irrelevant. So your total capital, we mentioned, is $1,000 and I want to risk 1%. We're longing, and leverage doesn't really matter for now. It matters after we define these things. So entry, let's say $90,000. Oh, $90,000. Stop was at $89,000. Oh, and exit was at $93,000. So you can actually see here, it's correct, the risk to reward ratio is 3. And you can also see here, risk capital $10 and estimated profit and loss $30. Exactly what we want, so you know this is correct. Now something very important is your position size. You see it here. This does not change. Look, actually, because I explained this, I'm changing the leverage. This does not change your position size. That only changes your margin, as I mentioned, the money you actually put in from your own capital, and your liquidation. And now the final thing, the only thing you have to do is decide how much leverage you use, because as mentioned, you don't just say I'm using this much leverage. Leverage is based off your position size and your stop loss, of course. So let's change this, and you have to look at the liquidation price. Oh, it's red, which means your liquidation is above your stop loss. Remember, in this example I mentioned you have to have your liquidation below your stop loss, and of course when you short, just vice versa, it has to be above your stop loss, but below your stop loss. And that's perfectly what's happening right here, but not right now. Now it is, and of course it does not really matter the exact amount. We can do 35 now. So the only thing you have to do now is just go to your exchange or broker or whatever you trade. You go to the coin you want to trade, Bitcoin now, and you just limit order, you do the entry at your price. Of course that's the first thing you do, because they have to do the calculations based off your entry. You don't really have to put your stop loss in yet, you can already do it, but that won't change much. And then you fill in your position size, which gives it here is 0.01, and then you change the leverage, and leverage will not change your position size, it will not change your potential profit or loss. That will only change the amount of margin of yourself you'll be using, because as I see, if I only use one leverage or no leverage, I'll be using $900 of my $1,000 capital, and we don't want to do that much. Of course you can, it's the same, but why would I put $900 of my own in it when I can perfectly do it with, let's see, 35, and I perfectly can enter only $26 and have the same result. You understand me? It does not matter, but just it's more logical to do. So position size won't change. You do this, you fill in your leverage on your exchange, and then you will see you'll be using that amount of margin. It's that simple. And now that seems like a lot of work to fill in, but when you're quick, when you understand everything, you can do this in 5 seconds and it doesn't take time. When you're an experienced trader and you have a set balance, for example, you have a funded account of $100,000, you already know if I'm trading this coin, I'm risking that much, I know my position size will be around this and I can use this leverage. Very, very simple. So this was it. This is the core of trading, risk management and your position size. You have many people who don't calculate their position size. They can surely make profits, but in the long run they won't be profitable and they will be losing money, they will be blowing accounts. I hope you understand what leverage is. It could still be a bit vague or a bit, you don't know exactly what it is. You may have some idea, bigger position to trade with, but I don't really understand it. Inform yourself, look it up, ask AI, join the server. You can ask me questions as well. There's also, as I mentioned, written text about what leverage is, and then you'll surely understand it. If you don't understand it yet, it's no problem, because you're not actually trading yet. And when you start trading yourself in a couple of weeks, months, you'll surely understand how to do it. And if you make mistakes, so be it. You'll surely lose money, not thousands of dollars, but you can surely lose a couple of bucks by making some mistakes, but that's all part of the journey. I want to thank you guys for watching. If you watch this video fully, it means you're really locked in on trading, and I'll see you guys in the next episode.